Yeah, good evening.
Good evening,
Good
sir.
We
evening,
don't,
sir.
yeah, good evening. Yeah. So today we are going to be dissecting the concept of risk and uncertainty. We have limited time, considering the official uh, closing period or end of end of diet lectures. All right. Officially, our online class is expected to end um, by end of April, which is 30th of April. But the physical students class will end by April 26th, which is this coming Sunday. And we still have some topics to cover. Therefore, um, today's class will be very straight to the point. I may not have the opportunity of defining and then giving you all the details because right now, for us to be able to complete risk and uncertainty, I need minimum of 2 periods, and we only have today and then Friday to be able to do that. And I still have some topics to take you. For FM student, I still have business valuation after risk and uncertainty. For PM, then I still have learning curve theory. But in any case, be rest assured that we are going to cover all of them. All right. So I was told that for those of you that are doing audit and assurance and for audit assurance and forensic, the lecturer told me that he is done with you. So there's likely that we may also meet on Thursday. All right. So depending who need time more between between myself and the other lecturer or Mr. Wasil Yusuf that usually take you peace off on Saturdays. So in any case, so bear in mind, I can come up to you to say that we are going to meet on Thursday, all right, so that we can finish without extending to the month of May, all right? Okay, then. Now, what do you understand by risk and uncertainty? As an introduction, um, businesses operate in an environment that involves the element of risk and uncertainty because um, budget estimates, cash flow projection, market demand may be different from actual due to some external factors that are beyond the company's control. For example, markets market risk or legal factors, technological factors may limit the ability of the company to take advantage of market condition. All these factors are beyond the control of the business. You can imagine what happened in 2020 due to COVID-19. Nobody saw it coming. No business in the entire world expected that COVID-19 will come in, right? So it's beyond any control or anything, any factor that is beyond a company's control can resort to risk, right? So this is what we want to discuss because as a decision maker, as a manager, or as an individual investor, it is important to incorporate the element of risk and uncertainty involves in the variability of cash flows when making business or investing decision. You need to incorporate, in order not to be overly optimistic, it is essential to incorporate the element of risk and uncertainty into the variability involved in cash flow estimates. All right. So you can read about the meaning of risk, all right, the meaning of uncertainty. You can read about the method of incorporating risk and uncertainty. That is where we have major work. So our approach will then be that I'll be picking one of them, I mean, some of them that are relevant to our discussions, that I will talk about it. I will give you the details, what you need to do under each of them. All right. So, but as far as this level is concerned, it is essential for you to understand all relevant methods of mitigating risk and uncertainty. Examiner can ask you, all right? So just master, like, if you can do more than 5, fantastic, all right? So as far as our class is concerned, we are going to discuss risk-adjusted method. We discuss certainty equivalence. We are going to discuss expected value method, standard deviation and coefficient of variation. We are going to discuss simulation, sensitivity analysis, and then decision tree. All right. Then, of course, in addition to this, for performance management, additional scope in performance management, we are going to discuss decision analysis, where you have Maximus, Maximi, Laplace, Bayes. So we are going to discuss that in addition to the scope of FM. All right, so let's start with risk-adjusted method. What do you mean by risk-adjusted method? It is a method of mitigating risk and uncertainty whereby a risk premium is added to the existing cost of capital when evaluating a project. What do I mean by that? Let's say, for example, you want to evaluate a project using NPV, right? So, and you are given the company cost of capital is 10%, okay? So you are going to be given a risk premium. Let's say a risk premium is 2%, all right? Risk premium is 2%. So instead of appraising the project, instead of evaluating the project using 10%, you are going to use 12%. All right. So if the project produces a positive NPV using this 12% cost of capital, then it means that the project is financially viable. This is what you need to do under risk adjusted method. I will repeat. Under risk adjusted method, you are supposed to add a risk premium to the existing cost of capital in order to adjust for the risk associated with the project. So if the total cost of capital, that is the existing cost of capital plus the risk premium, if it produces a positive NPV, then the project is financially viable. But if not, the project will not be undertaken because it will be too risky to undertake such a project. That's all you need to do under the risk adjusted method. The second one is risk certainty equivalent method. Certainty equivalent method is also a method of hedging risk and uncertainty by using equivalent factor, to adjust for the risk inherent. Some of you are still making noise from the background. Stop it. Imem and Nandi, stop it. Mute yourself. So for the certainty equivalent method, you are expected to adjust for the risk inherent in the project using equivalent factor. So that coefficient will be given to you on the day of your exam. Once you see the equivalent factor or coefficient, you should know that you are going to use certainty equivalent method to adjust for the risk. How do you do this? Very simple. So the PV, you are going to, just the same way you normally calculate your NPV. Remember, when you are calculating NPV, we said net present value represent the difference between the PV of cash inflow and the PV of cash outflow. This is the way we would normally calculate our NPV. It's still the same thing. The only difference is just that, to get the PV of cash inflow or to calculate your PV, PV is equal to cash flow multiplied by discount factor. This is what we normally do to get our present value. But using certainty equivalent method, the PV will be calculated as cash flow multiplied by discount factor multiplied by equivalent factor. So equivalent factor is just an addition, so it will be given to you. So you use that equivalent factor to adjust for the risk inherent in the project. So if after your calculation of NPV, you have a positive result, then it means that the project is financially viable. But if you have a negative NPV, the project will not be undertaken. So that is what you need to do under certainty equivalent method. Let me see. Let me check for, if I can, let me check for example so that we can quickly go through that. Um, Actually, certainty equivalent, all this, they are just elementary methods of hedging risk. But you never can tell. At this level, examiner can ask you. So don't let us ignore it. Let me just use a work example to explain that for you. Just 1 minute. Let me bring up Golden Book to use it to explain that. Uh, Let me see. Trying to open it. 1 minute. Certainty equivalent method. Control F. Okay, let me share my screen. I don't know, where are you? 237. Still loading. Just give me a few minutes. I've just checked 237. It's still loading. I can't wait. 250. That's 250. Capital rationing. Garage. Um, okay. 260. Okay. Yeah, this is it. Yeah. Let me look for example to demonstrate that for you. Risk adjusted. Yeah. So like I said, this is an example. Let's go through the examples together. This one is for risk adjusted method. ABC Limited has decided to commit 800,000 naira into a project for a period of 4 years. The expected annual cash flows are given below. The company's cost of capital is 10%, while a risk premium of 5% has been added to account for the variability in the cash flows. Required, advise the company if the project should be accepted using risk-adjusted method. So I want to calculate NPV using risk-adjusted method. What are you supposed to do? Like I said, under the risk-adjusted method, the most important thing to do is to add the existing cost of capital with the risk premium provided for you. So like in this case, the existing cost of capital is 10%. The risk premium is 5%. Therefore, instead of appraising the projects using 10%, we are going to use 10% plus 5%, making 15% cost of capital. So if the project produces a positive NPV, then it means that the project is financially viable and should be considered. Okay, so let's look at the solution here. So I've also explained that to calculate the NPV, the project cash inflow will be discounted at 15%. That is, the existing cost of capital of 10% plus risk premium of 5% instead of the normal cost of capital of 10%. Okay, so the cash flow for each year, year zero, initial outlay is 800,000. Year one cash inflow is 300,000. Year two cash inflow 250. Year three is 400. Year four is 200,000. All right. So the cost of capital that we are going to use will then be the existing cost of capital plus the risk premium, which is 15%. 10% plus 5%, that's 15%. So discount factor for year one at 15% is 0.870. Discount factor for year two at 15% is 0.756. Year three is 0.658. Year four is 0.572. When you multiply that with a cash flow, so you are going to get the present value. So 300,000 multiplied by 0.87 will give us 261,000. 250,000 multiplied by 0.756 will give us 189,000. 400,000 multiplied by 0.658 will give us 263,200. 200,000 multiplied by discount factor of 0.572 will give us 114,400. We then add up all the positive present value. That will give us 827,600. We then less initial outlay, present value of initial outlay 800. So that will give us NPV of 27,600. Since our NPV is positive, it means that the project is financially viable and should be undertaken. So this is what you need to do under the risk-adjusted method. The risk premium will surely be given to you. Just add the risk premium to the company's cost of capital, all right? Then use the combined cost of capital to evaluate the project. If your NPV is positive, you accept. If NPV is negative, you reject it. That's all you need to do. So the second one is certainty equivalent method. Like I said, the certainty equivalent method is a method of hedging risk and uncertainty whereby equivalent factor is used to reduce the risk inherent in a project. All right. So in this case, to calculate net present value, you are supposed to multiply the cash flow with the discount factor and also equivalent factor given to you. The equivalent factor is usually between the range of 0 and 1. Okay, equivalent factor ranges from 0 to 1. All right. So, of course, the project should be undertaken if the NPV is positive. But if the NPV is negative, you have to reject the project. That's all you need to do. Now, let's have an example here. Let's have an example. Awilo Limited has the objective of maximizing shareholders' value. The company is considering investing 1 million naira. This is supposed to be 800,000. Let me see. Okay, it's 1 million. Let's move on. The company is considering investing 1 million naira in a project for a period of 5 years. The project is expected to generate the following annual cash inflows with their respective certainty equivalent factor. Okay, so examiner has mentioned certainty equivalent factor. Something should call your mind that this question relates to certainty equivalent method. All right, so we are given cash flow. We're also given equivalent coefficients. Okay, the cost of capital is 10%. You are required to advise Awilo Limited. What am I supposed to do? Very simple. Using certainty equivalent method. Using certainty equivalent method, your present value will be computed as cash flow multiplied by discount factor multiplied by equivalent factor. That's all you need to do. Just introduce equivalent factor. So that way, if your NPV is positive, you accept. If not, you reject the project. So let's see our calculation here. Now, so I've also explained further here. To calculate the NPV, the cash inflow generated by the project will be multiplied with the discount factor and equivalent coefficient to get the annual present value. This is shown in the calculation below. You can see, ordinarily, when we are calculating NPV, we just multiply the cash flow with a discount factor. That's the normal thing we do when we are calculating NPV. But because this is certainty equivalent factor, so you need to add, you need to multiply, in addition to discount factor, you also multiply with equivalent factor, all right, in order to get the present value. So that's what we have done here, all right? So like I said, the equivalent factor or equivalent coefficients will vary between 0 and 1, okay? So to answer the question, initial outlay is 1 million naira. Present value at year 0 for 1 million naira still remain the same. Year 1 cash inflow is 200,000. Discount factor at 10% is 0.909. Somebody may ask, how do you get your discount factor? As you know, discount factor is equal to 1 plus R raised to power minus N. R is the company cost of capital. N is the useful life. For example, if you want to calculate discount factor for year 1, this will be equal to 1 plus R is 10%. 10% plus 1, that will give us 1.10. Then raised to power year 1, which is minus 1. So this will give you 0.909. Okay, because those of you doing PM, you have not done capital budgeting, so discount factor may look strange. All right, so you then multiply with the equivalent factor for year 1 as given to you. Of course, certainly, equivalent factor will be given to you on the day of your exam. All right, so you then multiply the 3 of them. We got 162,529. The second cash flow of 400 multiplied by discount factor of 0.826 multiplied by equivalent factor of 0.811. That's what produced 267,954. The third cash flow is 500,000 multiplied by discount factor of 0.751 multiplied by coefficient of 0.746, and we got present value of 280,123. The fourth year cash inflow is 700,000 multiplied by discount factor at 10% for year 4, which is 0.683, multiplied by equivalent factor of 0.701. We got present value of 335,148. And the last one, the last cash inflow is 200,000 for year 5. Okay? Multiplied by discount factor for year 5 at 10%, 0.621. The equivalent factor given to us is 0.690. By the time you multiply the 3, we have 85,698. You then add up all the present value. That will give you 1,131,452 naira. So the difference between 1,131,342 naira minus 1 million, that's what gave us the NPV. That's what gave us the NPV of 131,342. So because our NPV is positive, you then say the project is financially viable and should be undertaken. All right. So this is what you need to do as far as certainty equivalent method is concerned. Yes, Lekon, what's your question?
Please, my network was lagging. So how do you get the coefficient, sir?
It's always given. The coefficient will be given to you in the question.
Okay, thank you, sir.
This is it. It will examiner will always give it to you. All right.
Yes,
The
sir,
risk
thank you.
premium, yeah, the risk premium too. The percentage of the premium will also be given to you. All right. So these are the things you are going to see. You'll be looking out for in a question for you to know which method you should use for the purpose of the evaluation. If examiner wants you to use risk adjusted method, that risk premium will be given to you. If examiner wants you to use risk certainty equivalent method, the equivalent factor or equivalent coefficient will surely be given to you. So when you see it in a question, you will know the right approach to solve the question. So let's move to expected value method. Now, expected value method simply represents expected value method. Expected value represents the averaging possible outcomes. All right. When you average the possible outcomes, that means you are determining the expected value. So to calculate the expected value, you are supposed to multiply probability with cash flow. If in a question you are given probability as well as a cash flow, then of course that means, and you are asked to evaluate the project, that means you are supposed to use expected value. You are supposed to use expected value method for the purpose of the evaluation. Okay. Now, the expected value method is mostly preferred by a risk-neutral individual or risk-neutral decision maker or investor or manager, because a risk-neutral does not seek or avoid risk, and he or she is willing to accept any outcome under any condition or state of nature. So as far as expected value method is concerned, all you need to do is to just multiply probability with cash flow. All right. That is to calculate expected value. Expected value is denoted as X bar. So it's computed as summation of probability of X. That is multiply probability with the cash flow. The probability is usually attached to state of nature. At times, examiner may not give to you probability, but you are going to be given state of nature. State of nature is the event in the economy. In the economy, you can have good, bad, worse. You can have boom, steady, recession. You can have high, medium, low. You can have above, average, below. You can have optimistic, most likely, pessimistic, any condition. Once you see those kind of things in a question, you should know that those are states of nature. So if you are not given a probability, certainly state of nature will be given to you. So you can then use the information given on the state of nature to derive your probability. But at this level, in most cases, you are going to be given probability. So if you are given probability, you are also given cash flow, and the examiner is asking you to calculate the expected NPV, or you should calculate expected value. So all you need to do, just multiply probability with cash flow. That will give you the expected value. So you can have for different state of nature. All right, let's say for example, we have high, medium, then low. So you are going to, this represents the state of nature. This is the state of nature. So the probability will be given for each state of nature. You can be given probability of, let's say, for example, 0.50, 0.20, then 0.30. At all times, your probability must be equal to 1. Okay? So you can also be given cash flow. For example, you can, let's say this one is 1,000, this is 800, and this is 500. And you are now asked to calculate expected value. So this is the cash flow given, this is the information given to you, and you want to calculate expected value. All you need to do is to just introduce additional column. You introduce additional column for your expected value. And you know that expected value is probability multiplied by cash flow. In this case, 50% of 1,000 will give us 500. 20% of 800 will give us 160. All right. 30% of 500 will give us 150, I think. All right. Then you add up everything together. This should be your expected value. That will be 810. So expected value is equal to 810. So with this, we have adjusted for risk, because probability is used to adjust for risk. I did not define probability earlier because of time. So you use probability when you talk about risk. Risk is a situation whereby future outcome is unknown, but it can be predicted with probability and past experience. So when you are using your past experience, when you are using your experience and also probability to predict future outcome, that is a risk. But uncertainty, you cannot use probability and past experience to predict future outcome. That's just the difference between the two. But generally, both risk and uncertainty are used interchangeably. We use them together. No distinction. All right. So this is how to calculate expected value. Once you are given probability and cash flow, and you are asked to calculate expected value, just multiply the two together to get your expected value. It's as simple as that. For those of you that are doing FM, you will know that we have done this under portfolio theory. Okay? Now, examiner can ask you to calculate expected net present value. There is difference between expected value and expected net present value. When you are asked to calculate expected net present value, you need to first of all calculate expected value before you go ahead to calculate expected net present value. So expected net present value will be computed by first calculating expected value using this formula. You then use your expected value to go and compute NPV. The result is known as expected NPV using expected value method. So let me see if I have it here. Yeah. So this is it. This is the information here. The expected net present value is calculated by using the expected value estimated for the relevant years to calculate NPV. This means that instead of using expected future cash flows to compute NPV, the expected value will be used. So you use expected value to compute NPV. So that's all you need to do. So let's move to standard deviation. We are going to use two different questions to calculate expected value, standard deviation, and coefficient of variation. So let's move to discussing standard deviation. Okay, what do you mean by standard deviation? Standard deviation represents a statistical measure of absolute dispersion and is a measure of spread about mean value. Standard deviation is used to measure the risk associated with a project, and the higher the standard deviation, the more risky the project. All right. You use standard when you want to measure the risk inherent in a project, you use standard deviation to do that. All right. So if the standard deviation is high, it means that the risk of the project is high, and vice versa. Where you have different alternatives, any alternative or any project with a lower standard deviation will be preferred. Of course, at times, the examiner may want you to calculate expected return and standard deviation of different projects or different alternatives. What this simply means is that at times, project A, for example, if you have calculated expected value for project A, you also calculate standard deviation for project A. Let's say project A expected value is 120. Project B expected value is 150. Standard deviation of project A is, let's say, 8. Standard deviation of project B is 12. If the examiner is now asking you, which of the project will you select? So decision to select, the decision to select either A or B will depend on the risk appetite of the individual decision maker. Remember, some of you that are doing FM, when we did portfolio theory, we said that the higher the risk, the higher the return. So if your expected value is lower, your standard deviation should also be lower. The reason being that, this your expected value is more like your return, right? So you cannot be having a lower return and you're having a higher risk. That would be too that would be too much to bear. All right. So of course, that's why in my own analogy, the risk of project A is 8, which is lower relative to risk of project B. The return of project A is lower relative to return of project B. Now, the choice between project A and B will depend on the risk, will depend on the nature and characteristics of the decision maker. If the decision maker is a risk taker, if the decision maker is a risk taker, such individual will select project B that has higher return with a higher risk. But if the decision maker is a risk averse investor are those individuals that do not like risk. Therefore, such individual or such investor will select a project with a lower risk and lower return. So no one is better. It all depends on the nature and characteristics of the decision maker. All right. So that's what I want to explain there. Now let's move on. How do you then estimate standard deviation? Standard deviation is simply the square root of variance. Okay. Standard deviation is a square root of variance. Now, how at times examiner can ask you, and this is very common. Examiner can ask you, what is standard deviation of that you should calculate standard deviation of expected net present value? Okay, so how do you estimate standard deviation of expected NPV? Now, the standard deviation of expected NPV can be calculated in two different ways, depending on the nature of the cash flows. All right. So you can be given independent cash flow or mutually dependent cash flow. So there are different formulas that you can use depending on the one you have, but you have to master the two. Now, for mutually dependent cash flow, first thing first, what is mutually dependent cash flow? A mutually dependent cash flow is the one whereby the events of each year are the same. For example, if you have a project that has 3 years life, year one, year two, year three, and you are given a cash flow for year one to be 1,500. Year two cash flow is also 1,500. Year three cash flow is 1,500. That means the cash flow are mutually dependent. When you have the same cash flow for all the relevant years, it means that they are mutually dependent. Therefore, where you are given mutually dependent cash flow and you are asked to calculate standard deviation of NPV, then in that case, the formula to use will be the standard deviation computed multiplied by annuity factor. That is, to calculate the standard deviation of NPV, you go ahead and calculate standard deviation. You then multiply with annuity factor. Okay, this is it here. Whatever you have, that will give you the standard deviation of expected NPV. This standard deviation computed is the same standard deviation you have up there, which is square root of variance, summation of probability of x minus x bar square. All right. So you need to first of all calculate standard deviation using that formula. So once you have that ready, you then go ahead and calculate annuity factor. You know that annuity factor is computed as 1 minus 1 plus r raised to power minus n all divided by r. This is your annuity factor. So you first of all calculate this standard deviation. You then go ahead and calculate annuity factor. You multiply the two together. So that will give you the standard deviation of NPV. So like I said, you only use this formula. You use this formula only when you are given mutually dependent cash flow. And I said that mutually dependent cash flow is the one in which the events in each year are the same. Once you are given the same cash flow for all the relevant years, that means they are mutually dependent. Okay? So if you this, I won't advise you to use this formula because this one is faster. The second formula is faster. This one will take, let's say, for example, the project life is like 10 years. That means you are going to be doing for year one, you do for year two, you do for year three, up to year 10. It will waste your time. But this one, once you get your annuity factor, you calculate your standard deviation. So that's all. Before you know it, you are done. But whichever one that is more convenient for you, you do it. So because of time, let's move on. Now, the second one is independent cash flow. Independent cash flow. If you are given independent cash flow, how do you compute your standard deviation of NPV? First thing first, what is independent cash flow? The independent cash flow is a standalone cash flow in which the events in each year are different. Okay, when you are given different cash flow for all the relevant years, that means the cash flow are independent. Let's say, for example, we have year one, year two, year three for simplicity, and you are given cash flow for year one to be 5,000, cash flow of year two to be 1,000, cash flow of year three to be 2,000. Once you notice that cash flow of each year are different, that means they are independent of other years. So when cash flow are independent of other years, that means they are independent, they are standalone, they are on their own. So when this happens, the best formula to calculate your standard deviation of NPV is this one. The numerator, let me rewrite the formula. So then when you are given independent cash flow, standard deviation of expected NPV will then be computed as variance in each year, okay, divided by 1 plus R raised to power 2t. Then you find the square root. That will give you the standard deviation of NPV. All right. So the first one, the numerator, is the variance in each year. That is the variance in each year. T is the time period. T is the time period, like this case, year one, year two, year three. That's the time period. So R is the company cost of capital. R is the company cost of capital. Then 2 is constant. So put it in your formula. Before you know it, you are done. It's always very simple and straightforward. At this level, examiner can ask you, so don't ignore it. All right. So that is how to calculate standard deviation of NPV, where you are given usually dependent cash flow and when you are given independent cash flow. Now, the next thing we are going to discuss before we solve question is coefficient of variation. Coefficient of variation is a statistical measure of relative dispersion. Remember, standard deviation is absolute measure, it's a statistical measure of absolute dispersion. That's standard deviation. But coefficient of variation is a statistical measure of relative dispersion and is a measure of spread about mean value. The coefficient of variation is also used to measure the risk inherent in a project. And the higher the coefficient of variation, the higher the risk associated with the project or the alternative. But in a situation where two different projects with varying sizes are being considered, all right, standard deviation may not produce an optimal solution. So in this situation, a more relative measure of dispersion should then be used. That is coefficient of variation when you have projects with different sizes. When you have projects with different sizes, standard deviation may not be suitable. And the best method to use to evaluate such project will then be the coefficient of variation. So how do you then calculate coefficient of variation? The formula to use to calculate coefficient of variation will depend on the standard deviation and the expected value calculated. The formula to use to calculate coefficient of variation will depend on standard deviation and expected value calculated. If, for example, you have calculated expected value, okay, using this formula, summation of probability of x, summation of probability of x, that is, you multiply probability with cash flow. You also calculate standard deviation using this formula, which is summation of probability of x minus x bar square. So, and you are now asked to calculate coefficient of variation. You are asked to calculate coefficient, let me give a space. You are asked to calculate coefficient of variation. So in this case, my coefficient of variation will then be equal to standard deviation over expected value. Let me read. Over expected value. So this is the formula to use when you have all these variables, you have calculated this, you have calculated this, you are now asked to calculate coefficient of variation. So this is the formula to use. But if in the question you have calculated expected NPV, okay, you have also calculated expected, you have also calculated standard deviation of expected NPV, and you are now asked to calculate coefficient of variation. In this case, your coefficient of variation will then be equal to standard deviation of NPV using any of the two formulas I provided before, using either this or the other one, or you use this one, whichever one you use, okay? So once you have calculated your standard deviation of NPV, you just divide it with the expected NPV. That will give you the coefficient of variation. So like I said, the formula to use to calculate your coefficient of variation will depend on the standard deviation and the expected value you have computed. That's all you need to do. All right. So let me do a recap before we solve questions. Now, we started with expected value. We said that expected value represents averaging the possible outcomes, and it is computed by multiplying probability with cash flows. The expected value method is mostly preferred by risk neutral individual or decision maker because as a risk neutral does not seek or avoid risk, he or she will be willing to accept any outcome under any condition or state of nature. All right. And we said that to calculate expected value, you just need to multiply probability with cash flow. But if you're asked to calculate expected net present value, the expected net present value should be computed by first calculating expected value. You then use the expected value to go and calculate NPV. The result is known as expected net present value using expected value method. We then proceeded to discuss standard deviation. We said standard deviation is a statistical measure of absolute dispersion and it's a measure of spread about mean value. We use standard deviation to measure the risk associated with a project. And we said to calculate standard deviation, we find the square root of a variance, which of course I provided you with the relevant formulas to use. We also talked about standard deviation of expected NPV. All right. So we said to calculate standard deviation of expected NPV, the formula to use will depend on the nature of the cash flow. So if you are given a mutually dependent cash flow, you use either this or you use this. But where you are given independent cash flow, this is the formula to use to calculate your standard deviation of NPV. And lastly, we spoke about coefficient of variation. We said coefficient of variation is also a statistical measure of relative dispersion, and it is a measure of spread about the mean value. Coefficient of variation is also used to measure the risk associated with a project. Okay? And we said to calculate coefficient of variation, the formula to use will depend on the standard deviation and standard deviation and the expected value calculated previously. So now I demonstrated this. When you calculate expected value in this form and standard deviation like this, then formula to use to calculate your coefficient of variation should be this. Also, if you have calculated expected NPV previously, you also calculate expected net present standard deviation of expected net present value, and you are asked to calculate coefficient of variation. That would be the ratio of standard deviation of expected NPV over expected NPV. So that's that. It's always very straightforward. At this point, let's have illustration. Let me check your learning material and pick some. So all the information are there in your learning material, so you can always read them through. Let's have illustration to that effect. Let me see. Okay, expected value, variance. Okay, let's solve this illustration number 5. Equatorial Limited has an investment proposal that has the following probability distribution of return. We are on page 72 in your learning material. Okay, so you are given cash flow and probability for year 1, 2, and 3. The events of each year are independent of other years. The outlay on the project is fixed at 22,000 naira, and the appropriate discount rate figure is 10% required. Calculate the expected net present value, the variance of return in each of the years, the standard deviation of the net present value, and then the coefficient of variation. So that is the question. 4 requirements. Now, you want to calculate expected net present value. What are you supposed to do? First thing first, you have to calculate expected value by multiplying cash flow with the probability. You then use your expected value to go and calculate NPV. The result is expected net present value using expected value method. So let me just switch. Because of time, let me switch to the working notes quickly. So like I said, go to page 72, illustration number 5 in your learning material. So you also have the same question in both FM and PM. So let's go through it together. Share. Let me even open solution to illustration 6, page 72. Page 72 of FM. Let me check. Let me check the page in PM.
Page 62.
Page 62, right? Okay, thank you. What's illustration?
Sorry, page 65, illustration 5.
Okay, so this is page, and let me see, and uh illustration. You say illustration 5, right?
Yes, sir.
Page 62,
65.
65 of PM. Yeah, thank you. All right then. So the name of this company is Equatoria Limited. Requirement number 1 says we should calculate expected net present value. We are to calculate expected net present value. For us to be able to do this, we need to first of all calculate expected value. All right. So I will then come here. Requirement number 1, calculating expected net present value. So you design your table, you create a column for year, description of items, cash flow, discount factor at 10%. Then we have the present value. We then go back to the question. What's the useful life of the projects? The useful life is for 3 years. Okay, useful life is 3 years. So we then have year 0, year 1, year 2, and year 3. We go back to the question to check if you are given a scribe value. So we don't have scribe value in the question, right? So we then move on. So here will be initial outlay, which is 22,000 naira cash outflow. Discount factor for year 0 at 10% is 1. 1 multiplied by 22 will give us 22,000. Then we need to go and calculate cash flow, the expected return for each year. So we then go back. Let's say this would be for our variance. So the third page will be for our workings. All right. Let me do it this way. Let me start my working from here. Excuse me. So I will come here and say workings. Working number 1. I want to calculate expected value. So you are going to match expected value and variance together in a table. So remember, expected value is computed as summation of probability of X. Variance, okay, variance is also computed as summation of probability of X minus X bar square. Therefore, I will do for each year separately. For year 1, I will create a column for probability denoted as P. I will create another column for return denoted as X. I will create a column for expected return. Expected, let me shorten it. Expected return, so X bar. Then, because I want to calculate variance, I will need to expand this formula. So to do this, I will then say X minus X bar, then X minus X bar square, then probability, this my expected return is taking space. Let me adjust it. But let me just call it expected value, X bar. Okay, so here will then be X minus X bar, X minus X bar square, then probability of X minus X bar square. You will recall, for those of you that did portfolio theory recently, it's the same formula, it's the same format. We have done this before. So I will then go to year 1 in the question. What are the probability given to us? We have probability of 0.2, 0.4, and then 0.4 for year 1. Here is 0.2, 0.4, and then 0.4. So like I said, at all time, your probability must be equal to 1. Okay? Here is 1. Then the return for year 1, 6,000, 8,000, 9,000. 6,000, 8,000, 9,000. So to get the expected return, you just multiply the probability with the cash flow. Let me complete my table. This is variance. All right. So this is the formula to calculate expected value. So just multiply probability with the cash flow. So 0.2 multiplied by 6,000 will give us 1,200. 0.4 multiplied by 8,000 will give us 3,600. Is it 3,000? 3,200. 0.4 multiplied by 9,000 will give us 3,600. When you then add everything together, 36. So when you add everything together, we are going to have 8,000. So 8,000 is the expected value is equal to 8,000 for year one. So I will then go up there. My cash flow in year one is 8,000. I will then do variance, or first thing first, let's finish the expected value before we do variance. I will do for year two as well. Year two, the same way I've calculated for year one, I will do for year two as well. So we are going to have probability, cash flow, expected value minus cash flow minus expected value, cash flow minus expected value square, then probability with cash flow minus expected value square. So for year two, probability of year two is 0.5 and then 0.5. 0.50, 0.50. Return of year two is 8,000 and 12,000. So here is one expected value. So to get the expected value for year two, 50% of 8,000 will give us 4,000. 50% of 12,000 will give us 6,000. That means expected value is 10,000 for year two. So I will go up there and put it down, 10,000. Then for year three cash flow, do the same thing for year three. So probability, return, expected return, cash flow minus expected return, x minus x bar square, then p of x minus x bar square. Then we pick the probability of year three, which is 0.3, 0.5, 0.2, 0.3, 0.5, 0.2. Okay. Then the return of year three is 7,000, 11,000, 17,000, 7,000, 11,000, and then 17,000. So 0.3 multiplied by 7,000, that should be 100. 0.5 multiplied by 11,000, 55. 0.2 multiplied by 17,000 will give us 34. When you add everything together, that should be 11,000. So expected value for year three is 11,000. I will then go up there and put it down, 11,000. So I will then discount my cash flow to get the present value. So discount factor for year one at 10% is 0.909. Year two at 10%, that is 1.1 raised to power minus 2, that's 0.826. 1.1 raised to power minus 3, that will give us 0.751. So we then multiply with the cash flow. So 8,000 multiplied by 0.909, 7272. Here will be 10,000 multiplied by 0.862, that's 8260. 11,000 multiplied by 0.751, this should be 8261. Our expected NPV will then be equal to 7272 plus 8260 plus 8261 equal 23,793 minus 22,000. That is 1793. 1793. You then say the expected net present value of the project is 1,793. That's it. This is how to calculate expected NPV. You calculate expected value, you then use the expected value to compute your NPV. The result is known as expected NPV using expected value method. So the second requirement, we have to calculate variance. Calculating variance of each year. All right. You have to calculate variance in each of the years. So we have column for year, then column for variance. Year one, year two, year three. So let's go and calculate our variance now. So to get the variance, remember, this is the formula for calculating variance. Summation of probability of x minus x bar square. So we've already lay out our table. Therefore, to get our variance, first thing first, you need to determine x minus x bar. Expected value, which is 8,000, is the x bar. The return is x. Therefore, 6,000 minus 8,000 will give us minus 2,000. Minus 2,000 square will give us 4 million. 4 million multiplied by probability of 0.2 will give us 800,000. Next one, 8,000 minus 8,000 will give us 0. 9,000 minus 8,000 will give us 1,000. 1,000 square will give us 1 million. 1 million multiplied by probability of 0.4 will give us 400,000. When you add it together, that will give us 1,200,000. That's the variance of year one. I will then go and post 1,200,000. Variance of year 2, do the same thing. To get the variance of year 2, you pick the cash flow, which is 8,000, minus expected value of 10,000. That's minus 2,000. Minus 2,000 square will give us 4 million. 4 million multiplied by probability of 0.5. That's 2 million. Next one, 12,000 minus 10,000 will give us 2,000. 2,000 squared is 4 million. Multiplied by 0.5, probability 2 million. Therefore, our variance is 4 million. We then go and post. Here is 4 million. The last one, variance of year 3. 7,000 minus 11,000 minus 4,000. Minus 4,000 squared will be 16 million. 16 million multiplied by probability of 0.3. That should be, is it 4.8? 4.8 million. 11,000 minus 11,000, 0. 17,000 minus 11,000 will give us 6,000. 6,000 squared will give us 36 million. Multiplied by 0.2, that was 7,200,000. Add everything together, that's 12 million. All right, variance of year 3 is 12 million. I will then go and post. You can see it's not difficult. Number 3, we have to calculate standard deviation of NPV. So calculating standard deviation of NPV. To calculate the standard deviation of NPV, I don't have space again. Let me go down there. Let's start from here. Number 3, calculating standard deviation of NPV. So to calculate the standard deviation of NPV, the formula to use will depend on the nature of the cash flow. If you are given, we then go back to the question and check what is the nature of our cash flow. According to the question, you are told that the events of each year are independent of other years. That means we have a standalone cash flow. Even if the examiner did not say that, when you look at year 1, year 2, and year 3, you will notice that the cash flow of year 1 is different from cash flow of year 2. It's also different from cash flow of year 3. That means they are independent cash flow. Okay? So because we are given independent cash flow, therefore, our standard deviation of expected NPV will then be computed as square root of variance in each year divided by 1 plus R raised to power 2t. This is the formula we're expected to use to calculate the standard deviation of NPV. Okay? So I would then say standard deviation of expected NPV is equal to, we have calculated variance for each year. Variance of year 1 is 1,200 divided by 1 Cost of capital is 10%. Therefore, 1.10 raised to power 2 times year 1 plus variance of year 2 is 4 million over 1 plus cost of capital of 10%. That's 1.1 raised to power 2 times year 2 plus variance of year 3, which is 12 million over 1.10 raised to power 2 times year 3. You then find the square root. That's it. So first thing first, let's break it down further. Standard deviation of NPV will then be equal to 1,200,000 divided by 1.1 raised to power 2. 1.1 raised to power 2 will give us 1.21. Let me confirm.
Yes, sir. 1.21.
Okay. Then plus 4 million over 1.1 raised to power 4 will give us 1.4641. Okay. Plus 12 million divided by 1.1 raised to power 6. That will give us, I think, 1.771. 561. Please confirm the number for me.
Yes, that's correct.
Okay, then. So that's that. Then, at this stage, I don't need to be doing it one by one again. I will just get my final answer. MPV. I will just get my final answer. How do I do this? I'll bring out my calculator. Open a bracket. Open a bracket from your calculator. Then type 1,200,000 divided by 1.21. Close the brackets. Plus, open another bracket. 4 million divided by 1.4641. Close the brackets. Plus, open another bracket. 12 million divided by 1.771561. Close the brackets. Press equal to, we are going to have 10,497,476.5192, whatever. Then just press square roots directly. Just press square roots. That will give you 3,239.98, approximately 3240. Here is 3240. That's the answer. So that's the answer for number 3. Then number 4, we have to calculate coefficient of variation. So calculating coefficient of variation, CV. So CV, like I said, the formula to use to calculate your coefficient of variation will depend on the standard deviation and the expected value computed. In the question, we are required to calculate standard deviation of NPV and then expected NPV. So in this case, the formula to use to calculate our to calculate our coefficient of variation would then be standard deviation of NPV. Let me write it. Standard deviation of expected net present value over expected net present value. So which is equal to 3240 over 1793. So this will give us 1.81. That's it. You can see it's not difficult. You just have to know the right formula to use. Once you know that, you are good to go. Let me know if you have any question on this so that we can move to the next one. Any question?
I have a question.
Who is speaking? You did not raise your hand.
Sorry, so
Go ahead.
DA2. What I have in my book is 8 million. I don't know if the problem is from my own side.
Year 2 is what?
DA2 for the variance, what I have is 8 million.
Year 2 variance, 8
Yes.
million. It's 4 million. How could it be 8 million? You mean this one where I have 4 million?
Yes.
It can't be 8 million. Huh? How did you do your own calculation?
For the return part, 8,000 minus that 12,000 there. We don't give 4,000. Right?
What do you mean by 8,000 minus 4? Where did you see 12,000? Is that
Is
what
that
I
what?
told you? I said x minus x bar, 8,000 minus 10,000. This is not 12,000. This is 10,000. This is 10,000, not 12,000.
Okay, sir. Thank you.
Yeah, we hope it's clear now.
Yes, sir.
All right then. So let me stop sharing this and move to the learning material. Let's solve a question where you are given mutually dependent cash flow. Okay. Yes. Let's solve this illustration number 6. Justin Limited is considering whether to invest a project with which will entail immediate capital expenditure on equipment worth 40,000 naira. The expected sales volume from the project are given below. So you are given 6 units. The unit selling price is 15 naira. Variable cost per unit is 9 naira. Once sales are established at a certain volume in the first year, they will continue at that same volume in the subsequent years. So this is saying that they are mutually dependent. That simply means they are mutually dependent. The useful life of the project is 6 years, and the equipment would be sold for 5,000 naira after the end of the project. The company's cost of capital is 10%. You are required to calculate the expected net present value of the project, the standard deviation of the NPV, and then the coefficient of variation. That is the question. Justin Limited. This is on the same page 72. All right, so let me stop sharing this quickly. Within the next few minutes, should be done with this. I'll move to the next one. Solution to illustration 6. Is it 6? Yeah. Illustration 6, page 72. 72 of FM. Yes. Is it the same page for on PM? Is it the same page in PM as the one we saw before?
Yes, 64. Page 64.
Page, page 64. What illustration?
Illustration 6.
Oh, okay.
Yes, sir.
So page 64 of PM. All right. So the name of the company is Johnston Limited. The first requirements were to calculate the expected net present value of the project. So I would then say calculating expected net present value. The useful life of this project is 6 years. Okay. Now, when you look at the question, we are given probability and sales volume. Sales volume is not the same thing as cash flow because before you can calculate expected value, you have to be given cash flow and probability. In this question, we are not given cash flow. Therefore, we need to go and estimate cash flow based on the information given. In the question, you are given a selling price of 15 naira. You are given variable costs per unit of 9 naira. That means our contribution will be equal to 6 naira. You then use the contribution to multiply the sales volume to get your cash flow. Once you have your cash flow, you can then go ahead and calculate expected value. Okay? So let's quickly do that. Let's go and do our working. Let me move to the third page. Working number 1, we want to calculate contribution. Contribution equal to selling price minus variable cost per unit. So selling price is 15 naira, variable cost is 9 naira. Therefore, contribution per unit equal to 6 naira. Now that we have the contribution per unit, we can then proceed to get the total contribution. Because we have different sales volume, then our total contribution for each activity level will also change. So here will then be sales volume. So we have contribution per unit. Then we are going to have total contribution. Okay. So the first is call the sales volume for me, please.
Okay, sir. The first one, 2,000.
2,000,
1,800.
Okay.
1,500.
Uh-huh.
2,500.
And then
1,000.
1,000. So our contribution per unit is 6 naira. We then multiply to get the total contribution.
First one, 12,000.
12,000 naira.
Second one, 10,800.
10,800.
9,000.
9,000.
15,000.
9,000, 15,000,
Lastly, 6,000.
and then 6,000. So that represents our cash flow. Now that we have the cash flow, we can then proceed to calculate our expected value. So I will then come here. I want to calculate expected value. That will take me to working number 2 now. I'm going to merge it together. I want to calculate expected value. Expected value, variance, and standard deviation. Because we are going to need ordinary standard deviation to calculate the standard deviation of MPV. Again, as you know, expected value is denoted as X bar to be computed as summation of probability multiplied by X. Variance will be computed as summation of probability of X minus X bar squared. Then the standard deviation, ordinary standard deviation will be computed as summation of probability of X minus X bar squared, that is square root of variance. These are the relevant formulas to calculate the expected value, variance, and standard deviation. So I will then create a column for probability. Probability, cash flow. Let me write it out in full. Can this place accommodate? How many line is this one? 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Then the heading. I need two headings. Let me go to the next page. So I will then come here, create a column for probability, denoted as P, cash flow, denoted as X, expected value, X bar. Then we are going to have X minus X bar, X minus X bar square, then probability of X minus X bar square. Give me the probabilities.
0.15,
0.15, next,
0.20,
next,
0.35,
next,
0.10,
and then
0.2.
0.2. So when you add it up, your probability must be equal to 1. Okay. Let me complete my table. Expected value, variance. Okay then. So our cash flow for the first one is 12,000. Here is 12,000, 10,800, 9,000, 15,000, then 6,000. Let me confirm. Yes. So we then multiply. What's 15% of 12,000?
1,800.
1/8. Here will be 2,160. 35% of 9,000. What do you have?
3,150.
3,150. So 20% of 6,000 will give us 1,200. Add everything together. What do you have?
9,810.
9,810. That's our expected value. 9,810. That's the expected value. So I can then proceed to calculate my expected MPV. The first requirement says we should calculate expected NPV. So I will create a column for year, description of items, cash flow, discount factor at 10%, then present value. Year 0. Initial outlay is 40,000. Is it 40? Yes, 40,000. We also have scrap value of 5,000. Useful life is 6 years. So here is 40,000. Discount factor for year 1 is 1. So year 0 is 1. Multiply by 40, that's 40. Now, the useful life of the project is 6 years, and our cash flow is constant. Our cash flow is 9,810 for year 1 to 6. So year 1 is 9,810, year 2, 9,810, year 3, 9,810, up to year 6 is the same amount. So since we have constant cash inflow, we are going to calculate annuity factor of year 1 to 6 at 10%. So our cash flow would then be equal to 9,810. We're also given in year 6, we have scrap value of 5,000 naira. We are told that the equipment will be disposed of after the project for 5,000 naira. Therefore, we need annuity factor of year 1 to 6 at 10%. Let's go and do working for that. Let me see. Working number 3 now. For those of you doing PM, annuity factor. AF. So annuity factor is computed as 1 minus 1 plus cost of capital raised to power minus n. N is the useful life divided by cost of capital. So here will be equal to 1 minus cost of capital is 10% in the question. So 1 plus 10% will give us 1.10. Raised to power minus n. Useful life is 6 years. Divided by R. R is 10%. So this will give us what? Starting from the parenthesis, 1.10 raised to power 6 minus equal, then minus 1 equal, divided by 0.1 equal to 4.355. 3 decimal place, 4.355. So annuity factor of year 1 to 6 at 10% is 4.355. So here will be 4.355. Then discount factor for year 6 at 10%. That should be 1.1 raised to power 6 minus
0.564.
5.564. We then multiply to get the present value. 9,810 multiplied by 4.355 equal 42723. Then 5,000.
2,827.
2,820. You add up everything, 2,820 plus 42723 minus 40,000. That will give us 5,000 watts.
543.
5543. 5543. That's the expected net present value. You can see it's not difficult. You just have to know, you understand the concept and know how to apply the concept. That's all. Number 2, requirements. We are to calculate standard deviation. Calculating standard deviation of NPV. So standard deviation of NPV. So we need to go back to the question, what is the nature of the cash flow? We have identified already. We are given mutually dependent cash flow because our cash flow of 9810 is constant for the entire 6 years. Year 1 to 6 is the same cash flow. So because we have mutually dependent cash flow, then our standard deviation of NPV will be computed as square root, will be computed as standard deviation multiplied by annuity factor. Okay, so that means we need to go and calculate standard deviation. We already have our annuity factor to be 4.355. So we need to go and calculate standard deviation. So to do this, so we need to expand. Oh, I didn't even give space. So we need to expand this table. Therefore, 12,000 minus 9810. All right, 12,000
18.
Pardon?
And
What is
2,190.
2,190? 2,190. 2,190 square will give us, what do you have? 2,190 square?
4796.
4796,
100.
100. Multiply by probability of 0.15.
719415.
719. You say 195?
415.
415. Okay. The next one, 10,800 minus 9810. What's the difference?
990.
990 square. What do you have?
980 100.
980 100. Multiply by probability of 0.2.
196020.
020. Next one, 9,000 minus 9810.
Minus 810.
Minus 810 square.
656 100.
656 100. Multiply by probability of 0.35.
229635.
229635. Next one, 15,000 minus 9810.
5190.
5190 square.
26,936,100.
Multiply by probability of 0.1.
2693610.
The last one, 6,000 minus 9,810
Minus
minus
3
3
8
minus 3,810 square.
14
14
million
million.
516
14 million what?
516,000
516,000 multiplied by 0.2.
2,903,220
2,903,000
220
Add everything together.
6,741,900
900. So that's the variance. So we have calculated expected value. We have calculated variance. Then we need to calculate standard deviation. So to get the standard deviation, this will
Hello,
be
sir.
ordinary. Yes, talk to me.
The square root of
The last
x,
one.
yes, the square root of x minus x bar is 14,516,100. But the rest is correct.
100. Okay. Thank you. All right. So my standard deviation, let me find somewhere to put it. Okay, let me just put it there. Standard deviation, which is, let me use the formula I have up there. Should I? No, let me just come down here. This annuity factor has taken the space I'm supposed to put the standard deviation. So we said this is square root of variance, and variance is summation of P of x minus x bar square. So standard deviation will then be equal to square root of variance. Variance is 6,741,900. So what do you have?
2,597.
2,597. So that's the standard deviation. So now that you have the standard deviation, we can then proceed to calculate standard deviation of NPV. So we said standard deviation of NPV is standard deviation multiplied by annuity factor. Here is 2,597 multiplied by annuity factor of 4.355. What do you have?
11,310.
310. That's it. Then finally, number 3 requirements. We are to calculate coefficient of variation. Coefficients of variation, CV. So the formula to use for CV will depend on the standard deviation computed. So here will be standard deviation of NPV over expected NPV. So CV will then be equal to, our standard deviation is 11,310 over expected NPV of 5,543. This will give us 2.04. 2.04. That's the coefficient of variation. I think that's end of the question. That's end of the question. I overestimated the pages. That's okay. So let me know if you have any question on this. Otherwise, we are moving to sensitivity analysis. Any question? All right. So let's talk about sensitivity analysis. Now, let me just use this material to explain that instead of switching again. Sensitivity analysis. The sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. Go to your material so that you can follow through. All right. Sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variables. It measures how sensitive a project NPV is to changes in variable. Let me just put it down. This measures how sensitive is a project's NPV to changes in variable that make up the projects being evaluated. It is the degree of change, or let me call it measures the tolerable extent to which a project NPV can accommodate any change in variable before a project will become unviable. For this purpose, variables include number one, initial outlay, two, variable costs, number three, stage volume, number four, sales value, number five, contribution, number six, scrap value, number seven, cost of capital, number eight, project life. So depending on the variable, all right, so you want to measure what if our initial outlay increased by 5%? Can the project NPV still be positive? If you reduce the selling price or sales value or sales volume or product life, if you reduce the product life by 10%, can the NPV still be positive? This is what sensitivity analysis measure. A tolerable extent to which a project NPV can accommodate any change in variable before a project will become unviable. So the extent to which any of these variables can change for the project to become unviable, that is what sensitivity analysis measure. All right. So because of time, how do you then estimate sensitivity margin? Okay, calculating sensitivity margin of variable. Let me write it. Sensitivity margin, SM of variable. There are three different formulas that you can use to calculate sensitivity margin of variable, depending on the variable you want to calculate for. For all the variables excluding cost of capital and project life, the formula to use will be sensitivity margin of variable will be calculated as net present value over the present value of variable. For those of you that are doing PM, you will recall we did this. One of the questions we solved under short-term decisions, we use this particular formula, multiply by 100 over 1. When the examiner asks you to determine the sensitivity margin of supplying costs, remember, question on what's the name of that question again? The company, Divine Grace, yeah. Then number 2, you can also calculate sensitivity margin of cost of capital, which should be computed as internal rate of return minus cost of capital over cost of capital multiplied by 100 over 1. The last formula, you can be asked to calculate sensitivity margin of projects or product life, whichever one is the same. So this should be computed as project life minus break-even point of project life all over project life multiplied by 100 over 1. So what that simply means is that when you look at this number 2 formula, it means that you have to calculate internal rate of return first before you can calculate sensitivity margin of cost of capital. The third formula, which is project life minus break-even point of project life. Project life is the useful life of the project, so it will surely be given to you, but you are the one that will determine the break-even point of project life. Therefore, how do you calculate break-even point of project life? Calculating break-even point of project life. All right, there are 3 steps to do this. Step 1, reduce the life of the project by 1. Okay. Let's say, for example, if the useful life of the project is 5 years, you minus 1 from 5, that's 4. So that means you have reduced the life of the project by 1. Step 2, you then calculate NPV net present value of the reduced life. Okay, you calculate net present value of the reduced life. Then finally, step 3, you calculate break-even points of product life, product or project life, whichever one. Let me use projects. Okay, so you calculate break-even points of project life using the formula below. All right, so you can then say break-even points of project life equal to reduced life plus net present value of reduced life over net present value of reduced life plus net present value of normal life. All of this multiplied by normal life minus reduced life. The same formula you normally use for internal rate of return. Okay, so that's that. Where RL equal to reduced life, NL equal to normal life. Okay, so that's that. Notes. When calculating the sensitivity margin of sales volume, the present value of contribution should be used as the denominator. That's it. So anytime you are asked to calculate sensitivity margin of sales volume, you have to use the present value of contribution as your denominator. That's all you need to do. All right. Finally, anytime you have computed sensitivity margin, you have to interpret your results. Whether examiner asks you or not, you must interpret your results. Therefore, how do you interpret? Interpretation of results. There are two ways, depending on the variables you have computed for. For variables such as sales value, sales volume, scrap value, contribution, savings, or project life. Your interpretation should be that the variable should not fall below the percentage attained. Otherwise, the project will not be accepted. That's the first interpretation. If you have all those variables. The second interpretation for variables, including initial outlay, variable costs, incremental fixed costs, or cost of capital. The interpretation should be that the variable should not increase beyond the percentage attained. If not, the projects will not be viable. So these are the two different interpretations you are going to give to your calculation, to your result of your sensitivity margin, depending on the variables that you have computed for. So this is it. This is how to interpret your results. At this point, we can then have illustration. Sensitivity margin is very straightforward, provided you know what you are doing. All right. Before we begin to solve, let me know if you have any question on what we have discussed so far under sensitivity analysis. If not, we proceed straight to calculation. Let me share the learning material. Our time is fast spent. In fact, we should be able, because we still have a lot to cover. Even our class should be ending by 11:30, but I know some of you are already tired. Don't let me stretch you. All right. Somebody should read illustration number 4. Go to page 71, illustration number 4. Who is helping us to read it? Who is helping us to read quickly? Yes, Lekon, go ahead. Olamilekan or Guinea.
Okay, sir. Illustration 4 or 3.
3.
Okay.
Sorry, hold on. Illustration 4, rather.
Okay.
It's for Mississippi.
Mississippi PLC has sought your advice as a financial consultant on its investment proposal. It plans to diversify into production of toilet soap. You are provided the following information relating to the proposal. The initial investment in plants and equipment will cost 4.8 million naira. The plants are expected to have a lifespan of 10 years with negligible scrap value. The company plans to maintain a minimum of 80% of installed capacity each year. At this activity level, 240,000 units are expected to be produced. The annual production overhead, excluding depreciation, is estimated at 360,000 naira, while variable cost is planned at 18 naira per unit. The market research carried out favors settings the selling price at 24 naira per unit. The company cost of capital is 17%. You are required to A, advise the investment proposal is worthwhile. B, calculate the tolerable level at which the following can vary without any adverse effect on the investment proposal: initial investment cost, production cost, sales price, sales volume, variable cost, product life, cost of capital.
All right, thank you very much. So we have two requirements. One is to advise whether the investment proposal is worthwhile. That is, we are required to calculate net present value. Then number B of the question, you are also required to determine the tolerable level at which the following can vary without any adverse effect on the investment proposal. So examiner has mentioned tolerable level. That means you need to calculate sensitivity margin of all these variables. All right. So the first one, number A, you calculate NPV. Number B, you calculate sensitivity margin of the 7 variables given to you. Let me stop sharing this quickly. We'll move to the working notes. Within the next few minutes, we should be done. Let me see if I still have enough space. Let me extend. Additionally by 2 more pages. Okay. The name of this company is Mississippi Solution. So illustration number 4, page 71 of FM. Okay. So what's the page in PM? What's the page in PM? An illustration what? Okay. Let's move on. The name of the company is Mississippi.
Page 63, illustration 4.
Okay. And page 63 of PM. Mississippi PLC. All right. So number A requirements, we are to calculate net present value. So this is, we create a column for year, description of items, cash flow, discount factor at 17%, then present value. I won't be surprised at this level, this kind of question may be likely. Okay. So I want to calculate NPV. I'll then go back to the question, how do I calculate my NPV? You are given an initial outlay of 4,800,000. The useful life of this project is 10 years. I need cash inflow. Examiner did not give me cash inflow, but I'm given selling price. I'm also given variable cost. Selling price of 24 naira, variable cost of 18 naira. That means contribution per unit is 6 naira. So without wasting time, let's go and do working. So this would be for our NPV calculation. After NPV, the sensitivity margin of each of the variables. I don't want to overestimate pages. Let me just let me align my table. Year 0, year 1 to 10. This is for initial investments. Then we are going to have contribution. Then we also have year 1 to 10 for production costs. There is no scrap value, so this is the NPV. So after NPV, I can then do my workings. I will advise, then I will do my working. Please, on the day of your exam, your working should come last. Your working should come after all the relevant requirements. Don't miss your working in your main calculation. But because I don't want to be switching pages, that's why I have to do it like this. So working number 1, we want to calculate contribution. Why are we calculating contribution? Because we are given selling price and variable cost. And you know that contribution per unit is equal to selling price minus variable cost per unit. So contribution per unit will be equal to 24 naira minus 18 naira. Therefore, our contribution is 6 naira per unit. Now that I have contribution per unit, I can then determine total contribution. To get the total contribution, we are given total units, 240,000 units. You then multiply with contribution per unit of 6 naira. So this will give us what? 1,440,000. That's our annual contribution. Okay? So I will then come here. The initial outlay is 4.8. Let's reduce our number to thousands. So here is 4.8 million. Our annual contribution is 1,440,000. Production cost is 360,000, excluding depreciation, 4,800. Then we need to calculate annuity factor of year 1 to 10 at 17%. Working number 2, annuity factor. AF of year 1 to 10. So you then say annuity factor equal to 1 minus 1 plus R raised to power minus N divided by R. This will be equal to cost of capital at 17% cost of capital. So cost of capital is 17%. So here will be 1 minus 1.17 raised to power minus 10 divided by 0.17. What do we have here?
4.659.
659. That's it. So I will then come here. 4.659. 4.659. Why are we calculating annuity factor? The reason being that our contribution of 1,440,000 is constant. Our production cost of 360,000 is also constant, year 1 to 10. So it's the same amount you are going to have from year 1 up to year 10. So instead of doing it one by one, so calculate annuity factor. So you still get the same answer. And this one is faster. All right. So I need to get present value. 1440 multiplied by 4.659 equal 6709. Again, 360 multiplied by 4.659, 1677. Final answer, 232, positive. So because our NPV is positive, it means that the project is worthwhile. I will then say, I will advise. Examiner says you should advise the investment proposal is worthwhile considering the positive net present value of 232,000 naira. Okay, therefore, the investment proposal should be accepted. Let me shift this one down. Therefore, the investment proposal should be undertaken. So we are done with that. You pocket it, move to the next one. The next requirement, we have to calculate sensitivity margin of initial investments. So I can then proceed. Number B, calculating sensitivity margin. SM. So the first variable, number one, sensitivity margin of initial investments will be calculated as net present value over present value of initial investments multiplied by 100 over 1. NPV is 232. Present value of initial investments is 4,800. Okay. This is the PV of initial investment, 48. Multiplied by 100 over 1. What do we have here? 232 divided by 48. What do you say it is? 4.8%. So the implication of this is that what we are saying here is that this initial investment of 4.8 million, the initial investment we have here of 4.8 million can still increase by 4.8%, meaning that any further increments, if you increase this initial investment by 4.9%, this your NPV will be negative. So the tolerable level to which you can increase initial investment is 4.8%. That's the maximum. Any further increase will make the NPV to be negative, which means the project will not be viable again. That's interpretation. So I can then come here. You can still in this question, the examiner did not ask us to interpret, but it's your responsibility. You just have to interpret. I will then come here. The initial investments should not increase beyond 4.8%. Otherwise, the project will not be viable because of time. Let me stop there. Move to the next one. Our time is almost up and we have to finish the question. The second one, what's the second variable? Production costs.
Production costs.
So I will say sensitivity margin of production cost, which is NPV of 232 over present value of production cost of 1677 multiplied by 100 over 1. What do you have there?
13.8.
13.8%. This will have the same interpretation as initial investment. That is, the production cost should not increase beyond 13.8%. If not, the project will not be accepted. Okay, number 3. Sensitivity of sales price, which is NPV of 232,000 over present value of sales price. We don't have present value of sales price, so we need to go and calculate it. So how do we get present value of sales price? Let me come here. PV of sales price. Before you can get the PV of sales price, you need to first of all calculate the sales price. That is sales value. Sales value will be equal to number of units sold, 240,000 units, multiplied by selling price of 24 naira. So this will give you what?
760,000.
760,000. That's the total sales. You then calculate the present value of sales, which is the total sales of 5,760,000 multiplied by annuity factor of year 1 to 10, 4.659. So what do we have?
26,835,840.
835,
840.
840. Okay, so our figures are in thousands. So this will be 26,836. So here is 26,836 multiplied by 100 over 1. Final answer, what do we have? Let's move faster.
0.9.
0.9%. So what this simply means is that our selling price or our sales price can still reduce by 0.9%. Any further reduction will make the NPV to be negative. That our selling price of 24 naira, we can reduce it further by 0.9%. So this 0.9% is what will make the project to break even, to be zero. So any further reduction in selling price beyond this 0.9 will make the project to be unviable. So you need to interpret this. I would then say sales price should not reduce below 0.9%. If not, the project will not be accepted. Next. Is that number 4? Yes, number 4. What's number 4?
Sales volume.
Of sales volume. And we said that when calculating sensitivity margin of sales volume, you have to use the present value of contribution as the denominator. Therefore, NPV of 232, present value of contribution is 6709, multiplied by 100 over 1. Give it to me. What do you have?
3.5.
3.5%. These have the same interpretation as sales price. It then says the sales volume should not reduce below 3.5%. If not, the project will not be accepted. Number 5, sensitivity margin of what?
Variable cost.
Variable cost, which is NPV of 232 over present value of variable cost. We don't know the present value of variable cost, so we need to go and calculate it. So PV of variable cost. So for you to be able to get the PV of variable cost, you must first of all determine your total variable cost. Total variable cost is number of units, and we have 240,000 units multiplied by variable cost per unit of 18 naira. Is it 18 naira? Yes. So what do we have here?
We are
4 million
320,000.
320,000. That's the total variable cost. To now get the PV of total variable cost, it will then be equal to 4320 multiplied by annuity factor of 4.659. What do we have here? 20
20.
million.
126.
And then
880.
880. All right. So that will be 2127. 2127 multiplied by 100 over 1. What do we have?
1.2.
1.2%. This means that the variable costs should not increase beyond 1.2%. Otherwise, the project will not be accepted. Number 6, we have 2 more to go. Sensitivity
Product
margin
life.
of what? Of product life, which is computed as product life minus break-even point of product life over product life multiplied by 100 over 1. So in this case, we need to go and first thing first, we need to calculate break-even point of product life. You know, the useful life of this project is 10 years. So we need break-even point of product life. We then come here, calculating break-even points of product life. There are 3 steps, remember, to do this. The first step is to reduce the life of the project by 1. The useful life of this project is 10 years. 1 minus 10 will give us 9. Then step 2 says you calculate the NPV of the reduced life. Step 3, you calculate the break-even point of product life. So straight, I will then come here. I will say net present value of reduced life. Let's calculate NPV of the reduced life. So create a column for year, item, cash flow, discount factor at 17%. Somebody should give me annuity factor of year 1 to 9 at 17%.
4.450. 4.451.
4.451. Thank you. So year 0, year 1 to 9, year 1 to 9. NPV of reduced life. So initial investments, annual contribution, annual production cost. Here is 4,800 negative, 1,440 positive, 360 negative. Here is 1. Here is 4,800. So what do we have here?
6409.
6409. Then 360 multiplied by 4.451.
1602.
1602. Difference of 7. Therefore, I would then say break-even points. Step 3 says calculate break-even point of product life, which is reduced life plus net present value of reduced life over net present value of reduced life plus net present value of normal life. All of this multiplied by normal life minus reduced life. Okay? Reduced life is 9 years plus NPV of the 9 years, 7 over 7 plus NPV of normal life, 232. Normal life is 10 years minus reduced life of 9 years. Final answer. That will be 9 point what?
03.
9.03 years. So break-even point of product life is 9.03 years. So 9.03 divided by 10 multiplied by 100. Final answer, what do we have? That should be 9.7, I think. Confirm for me.
9.7%.
Okay, then. So I would then say the product's life of 10 years should not reduce or should not fall, should not reduce below 9.7%. We can still reduce the life of the project by 9.7. Any further reduction will make the project unviable. The last one, which is cost of capital.
Cost of capital.
Yeah. So I've exhausted my pages. Let me copy this. Grazie. Okay. What do I want to do? Okay. This place should be okay. Then number 7, sensitivity margin of cost of capital. And we said this is computed as internal rate of return minus cost of capital over cost of capital. Multiply by 100 over 1. So as you can see from this formula, we have internal rate of return. So what that simply means is that we need to go and calculate internal rate of return. So I will then come here, calculating internal rate of return. We have used, remember, to calculate internal rate of return, you are supposed to assume two discount rates that will produce two opposing NPV, a positive and negative NPV. We have calculated NPV before. We got two positive NPV of 232 and we use 70% discount rates. So let's assume 20% and see. So I will say assume 20%. So if 20% is negative, we then assume 17% at the second discount rate. But if this 20% is positive, we need to increase it to 25 to get a negative NPV. So create a column for year, description of item, cash flow, discount factor at 20%, present value. Year 0, 1 to 10, 1 to 10. NPV. Initial investments. Contribution. Production costs. 48. 1440. 360. Yes. What's your discount factor, annuity factor of year 1 to 10 at 20%?
4.192.
4.192. 192. Let's multiply.
6036.
6036. Next.
1509.
1509. Final answer.
Negative 273.
273 negative. So we assume 20% discount rates. We got a negative NPV of 273. So that means we are going to assume 17% as our second discount rate, which we got 232. All right. Therefore, we then calculate internal rate of return, which is A plus net present value of A over net present value of A plus net present value of B multiplied by higher discount rates minus lower discount rates. So our lower discount rate is 17% plus NPV of the lower 232 over 232 plus NPV of higher discount rate 273 multiplied by higher discount rate of 20% minus lower discount rate of 17%. So what's our IRR? 232 divided by 505, I think, multiplied by 3 equal plus 17. That's 18 point what?
10.38.
18.38%. So that's it. Our internal rate of return is 18.38. So I would then say 18.38 minus cost of capital of 17% over 17% multiplied by 100 over 1. Give it to me. What do you have?
8.1.
8.1%. So which means that our cost of capital, I would say the cost of capital should not increase beyond 8.1%. So or you can say the maximum level or the maximum increase in cost of capital is 8.1%. Otherwise, the project will not be viable. I think that's end of the question. That's it. This is how to calculate sensitivity margin. At times, examiner can pick only one variable in a question. Maybe you are asked to calculate NPV, for example, or you are asked to evaluate a project. Then examiner can ask you to calculate sensitivity margin of tax liability or sensitivity margin of working capital. So examiner can just bring only one variable and ask you to determine the sensitivity margin, just like we did for those of you that are doing PM, like we did in the question of divine grace under make or buy. Yeah, we are asked to determine the sensitivity margin of supplying costs. Okay, all right. So let me know if you have any question for me so that I can release you. You have tried. At least I've extended almost 20 minutes beyond the normal time. Thank you for that. So any question for me so that I can release you? I can see Michael Ame is still on, still here supporting me. I can see Adejimi Olalekan, Adewale Kehinde. Yes, Imam is still on. Esther Babalola, Idriso, Ijoma, Joshua, Matthew Olatunji, Michael Adebayo, Moses, Nandi is on. Ogini Olamilekan, Oluwatosin, Akinseye, Oriseneye, Temitope Ademuyiwa. Thank you, every one of you, for waiting behind. We are going to meet. We are likely going to meet on Thursday by the grace of God. I will let you know by tomorrow. I will let you know if we are going to meet on Thursday. All right, so that we can continue the risk and uncertainty. Okay, and then on Friday we meet again. So because right now we are getting close to the D-Day, so any opportunity we have, let's use that to cover. All right. Thank you, everyone. Good night.
Thank you,
Thank
sir.
you.
Yeah,
night.
good night.
Good
Bye.
night, sir.
Good night.
Thank you, sir. Good night.
Good night.